For big picture perspective, I want to bring in Karl Farmer, Vice President, Portfolio Manager and Investment Management Group at Rockland Trust. Karl, thank you so much for joining us this Friday. Happy Friday to you. Let's talk a little bit about, the market action this week. It's really been this kind of back and forth, risk off one day, risk on another day, and it feels like investors are still trying to read the tea leaves about the conflict in the Middle East between Israel and Iran. You had some news of positive steps in terms of the diplomatic process with European leaders, kind of trying to reach some kind of semblance of order there. But in terms of it feels like the market is unclear on how to read this. What's your take?
Oh, absolutely. Diane, thanks for having me on today. So you're right, spot on. Investors do not like uncertainty. And that's anything from what's going on globally to tariff uncertainty. Again, as a reminder, we're kind of getting close to the end of that 90-day delay. And certainly the modification, timing, and duration of that has created uncertainty that investors have to work around. Same thing in terms of supply chain management. Not sure how much inventory to order, if your pricing is going to change, and that has created uncertainty. I think what's fascinating is even with all the uncertainty, as you mentioned, crude's back above 70, I think you said 74 on the WTI, is we're looking at market levels that are pretty close to where they were in February, even with this. So as investors digest kind of what's been going on, where to go forward. I think you mentioned, the Fed still pricing in basically 2 more cuts by the end of the year. But probably not as a result of further inflation reduction, but perhaps slowing economic growth, depending on how the tariffs or sort of the global diplomacy comes out. They certainly want to avoid lowering rates too quickly, only to see a rebound inflation perhaps in the latter part of the year if that rears its head. So certainly kind of as the opener, I mean, you've seen that reaction in the Treasury yield curve, where the 2 years hovering near 4, 10 years still around 4, 4.5, and 30 years still close to 5. So certainly investors are trying to figure out where to go and what to do.
So speaking of where to go and what to do, next week is the last week of the month. Like, as you point out, the next tariff deadline is really almost upon us, a little more than 2 weeks away. Do you think the market is underpricing the risk of, if that timeline in terms of the pause, if we don't see progress, is the market underpricing the risk of that lack of progress?
Certainly could be. I mean, as a reminder, one thing to remember is that with the market rebound, the S&P's PE ratio, as you look forward, is still close to 21 times next year's earnings, and the 30-year average is around 17. So certainly we're pricing some optimism there in terms of how things unfold and recover. And, what could go right is if the, tariff escalation that we've been, subject to over the past couple of months, if that brings about desired changes and are eliminated quickly and you don't see those higher elevated pricing as we go forward. And if you see overseas tensions reduce, that can certainly help. But in terms of how things could unfold going forward, if you see escalations in overseas tensions, or if customers that ultimately do face higher prices respond with lower consumption, and businesses ultimately would make lower profits and perhaps see market multiple declines. The longer the period of higher prices that someone experiences, the more likely your behavior is going to change, and inflation expectations could rise. So you may be seeing some, underpricing in terms of what the uncertainty could be. And we haven't even kind of touched on some of the recent immigration restrictions and ICE activity that could hit the economy harder than maybe priced in as well.
So do you think in terms of that activity, do you feel like that will affect, because there, some industry watchers say that affects the job market. Do you have a similar take on that?
I think that's kind of accurate in terms of where we're seeing things. There's still so much uncertainty around what could happen as we move through the end of the second quarter. Hard to believe half the year's over. And as we move into Q3, I think you have to be certain in your bets that you're comfortable with the short-term volatility and that you keep the long-term picture in mind.
What's your outlook then for the second half of this year? Do you feel like uncertainty will still be, just have a seat at the table through the balance of this year?
I think you have to think so at this point, just because as we talked about that delay, that 90-day delay, you may see some modifications, but that's coming up in July. And then right afterwards, we're going to see how the second quarter, and if those are brave enough to predict their third quarter and give guidance, that's going to kind of dictate where the rest of the year ends up.
I want to talk about, I know you have a few picks that you like, some stock picks. One on your list, PepsiCo. It has underperformed the S&P 500 year to date, while Coca-Cola has outperformed. What do you like about Pepsi?
Well, one thing in terms of Pepsi compared to Coca-Cola is that both are certainly global leaders in beverages. We like Pepsi because of the snack food business as well. Certainly, the recent results have led to a low sentiment and a discounted multiple. Some of that may be GLP-1 related in terms of people adjusting their consumption habits. But even in that kind of environment, if you spread out overseas, they have the flexibility to offer value pricing across all their product lines. And you should start seeing some productivity savings and growing volumes from here. And you get a 4.4, almost a 4.5% yield while you wait. So those are some of the big reasons we still like Pepsi here.
Okay, and then let's talk about another pick that's in another sector on your list, Thermo Fisher Scientific, ticker TMO. It has also outperformed the S&P 500, but you like the PE here. So what is it that you like about the company and where you see it going?
No, sure. So certainly the risk of tariffs and cutbacks in research funding in the healthcare and diagnostic space has led to some of the weakness, as you've seen the stock come in quite a bit compared to what the market rebound has been. It's trading at the lowest PE multiple it's seen in the past 8 years or so. But the big chief thing we like here is that over 80% of the business, the recurring revenue, comes from consumables and services. The thing that kind of may still give people some pause is that if you see future activity that may slow and the multiple may not be as cheap as it appears if you start seeing Q3 and Q4. But moving across a broad spectrum of scientific fields across healthcare, life sciences, it's not all about government spending. And there's a big profit motive from a lot of their customers to continue research.
Okay, and then Karl, I want to ask you about this last pick on your list, UnitedHealthcare. Look, it's had a difficult year today. No one would argue with that. There are those who are in the camp that it is oversold. It seems that you are likely in that camp, and if so, where do you see it going?
No, sure, we are in that camp, and I certainly wouldn't say it's all smooth sailing from here. But you're certainly buying at good levels. You know, it's down from 600, been cut in half to about 300 on future growth concerns. People are questioning whether or not the Medicare Advantage membership had been fueling some of the incremental Optum success. But if you start getting the sense that Optum is still a source of strength, it's hard to kind of change mid-year the 2025 utilization kind of across their platform. But this is a smart company, and if you start getting proof that 2026 they get the utilization and pricing and everything else correct, certainly you can move higher than the 12 or 13 times earnings that you're seeing today and be rewarded.
Karl, I want to go back to a big picture thought from you. You gave kind of an outlook for the rest of the year as it pertains to expectations for theme in the market. What about the consumer? When you think about the consumer, what do you worry about if prices stay too high? When you think about the tariff risk and supply pressure, where do you see the consumer potentially buckling?
No, certainly. And I think just giving a quick example, if consumers are faced with higher prices than what they've seen before, you have to wonder at what level do they potentially delay major purchases, whether that's an automobile or appliances or whatever it may be, or besides just eating out. But those are changes that certainly affect everybody differently. But kind of across the board, you may start seeing that as you move into the summer and beyond. Certainly with the inflation, it's not like it's at zero. You've seen price activity increase. Thankfully the rate of change has been slowing recently. But if you start facing investors with longer term inflation expectations greater than today, you're going to see some cutbacks. Maybe they buy their second best alternative, or maybe they just continue to delay purchasing, which is going to have a ripple effect throughout the economy and profits as we finish out 2025 and move into 26. So that's sort of our worries at the market multiple we're currently trading at. It's not like you're sort of at the average multiple. You have a lot of optimism baked in around trading at a 20 to 21 times earnings multiple. And if we have certainly we've seen results of that in individual companies that investors are jittery enough that if you can't deliver and hopefully give some better promise and outlook for the future, you may be punished instead of rewarded.
All right, Karl, thank you so much for your perspective. That's Karl Farmer, Vice President and Portfolio Manager, Investment Management Group at Rockland Trust. Our thanks to Karl. Karl, have a great weekend.